Welcome to our session on three signal framework for evaluating current equity markets and developing an action plan. I'm Sharon and I will be the moderator for this session. Arun Kumar, our research head, will start the session.
Yeah, thank you, Sharon. Thank you all for joining this session. So the broad idea is that we've earlier discussed on how we use this three signal framework in order to take equity calls often, right? So this is something that we use on a month-on-month basis. So just broadly wanted to give some, this is a very long PPT that we usually do internally. This is this is what we do within our research team. So I've just crisply taken out some of the important slides, which I thought might give you some perspective on how to think about the current scenario. So overall, our framework has been reasonably simple, that we look at three things whenever we try to take a equity market call. So when I say equity market call, what do I really imply? See, for most of the clients, our starting point is a simple asset allocation where you generally ask the question saying how much into equity, how much into debt. Most of our clients would fall into the 70% or 80% equity bucket, some of them into the 50% equity bucket, some of them into the 30% equity bucket, and the remaining will go into debt. So based on higher the equity, generally the more the aggressive the clients are, right? So what we essentially mean is that when we say we take equity calls is that 80-90% of the times we will stick around the asset allocation that we have decided for the client. So we'll be okay with a plus or minus 5% deviation. At some point in time when market goes down or goes insanely up, we might want to rebalance it back if it moves beyond the plus or minus 5% target. So if 70% is my equity allocation and the allocation suddenly ends up being 77%, then we'll want to sell off some equity and then move it back to debt, and then again bring it back to that 70% equity, 30% debt. So this is what 90% of the times we'll be doing. But there are those scenarios where sometimes the equities become insanely expensive, and there are also those times when equities become insanely cheap. So at these two different extremes, we might either want to slightly reduce equities, or when it falls, we might want to aggressively increase equity. I said slightly reduce equities because by nature, the 30% debt which is there is already accounting for a defensiveness. So we don't want to go too defensive. So that's why we go slightly lower on equity when we think there's a bubble, and we go extremely high on equities when we think the valuations have become very, very cheap. So this is what we measure using a bubble market indicator. And the other is what we use something called the crisis plan. So what really decides whether it is a crisis or whether it is a normal scenario or whether it's a bubble is our broad framework, where we look at valuations, we look at where are we in the earning cycle, and we look at the broad sentiment. The earning cycle is the most critical thing, because over 5-year, 7-year time frames, net your returns will more or less mirror this. The valuation and sentiments are over and above this. These three give us a good way to gauge the markets. Right? So let's start with valuation. What we do internally is that we use something called the value meter. So what this essentially does is this puts together, instead of going only by a single valuation metric, we put together 4 metrics, which is we put together market cap to GDP, we put together PE ratio and price to book ratio, and earnings yield vis-a-vis where the debt market yields are. So it's a relative indicator. And so once we put together all these 4, we've seen that generally the signals are reasonably good enough. And because each and every one of these indicators have their flaws and they also have their positives, and in certain market conditions, all these indicators don't work. So when you aggregate it, you're able to ensure that when one indicator is going through a market scenario where it's not suitable, the other 2 or other 3 kind of compensate. Overall, we've seen that this smoothens out and makes the indicator reasonably good enough for us. And what we also do is we also compare it with other indicators, like what other AMCs are using, say what ICICI uses, or what these BAF products of other AMCs, just to broadly ensure that is our indicator giving us something completely different from what the other indicators are doing. So overall, these are the checks and balances that we do. So overall, we've seen that this is a reasonably good way to figure out where the valuations are. If at all, if it goes above 80, we find that to be very expensive. Between 70 to 80 is expensive. Right now, we are all, and between 50 to 70 is the neutral zone where it's neither too expensive. Now we are almost at 69 point something. So we basically rounded off to 70. So which means we are still in the neutral, but just bordering on expensive, right? Last month it was expensive. And like before that, when the markets fell, it was in the neutral zone. So overall, and if you look at most of the BAF models of other AMCs, we are reasonably in the neutral zone as per most of the BAF indicators. So overall, it's we can reasonably confirm that we are at neutral valuation, right? So this is our first view. So now that valuations are neutral, the next key question is, where are we in the earnings cycle? So as I told you, the broad idea is that if you really look at equity returns and we want to try to gauge where it will be 5 years down the line, we essentially have to ask the question what my earnings growth will be, and will my valuations move up or down, and then what my dividend yields are. Dividend yields are generally 1.5%. So that is a known number. So all I need to know is, will my earnings growth, if say it is going to be 15%, then I know that as long as my valuations don't pull it down, most likely I'll end up with returns around 15%. If my earnings growth is expected to be 10, then my return expectation should also be around 10. Similarly, if it is 20, it should be around 20. So that's how we try to take a view. If it is too low an earnings growth expectation, then we might get worried. Or if it is too, we are at the so now or if we think the earnings growth can be really high, then we become extremely positive. Now the question is, how do we figure this out? Because again, there are a lot of moving parts and all that. So again, we come with a 1,000-feet view. So this is just to say how earnings growth will not matter over a 1-year time frame, but as over a long year time frame, over 5-year, 7-year, 10-year time frame, you will see that predominant part of your returns will be contributed by earnings. So in the next 1 year, we can't predict because there's too many things happening and the valuations can go up and down. So which is why we take a slightly longer term view, especially when trying to gauge the markets, where significantly it is driven by earnings. And this is also proven by evidence, because if you look at the long term returns, right, you can see that Sensex gave close to 12%. Your earnings growth was also close to 12%, and your GDP growth is also close to 12%. So net, you can see all the three are pretty much very, very close to each other. And you can, and the best part about and now the next question is, how do we figure this? How do we know if the next 5 years my earnings growth is going to be good or average or bad? Is through this simple logic that earnings growth are generally cyclical. So which means there'll be 5 to 7 years where it's insanely high. You can see 93, 96 where the earnings growth of 45%. And then it goes through a long period of weak returns where the earnings growth was only 1%. Then again, it jumped to 25% for almost like 5-6 years. Then again, for a long period after FY08, almost till 2020, earnings growth was going through 5% CAGR. Almost for 10, 11, 12 years, it was at 5%. Now it's again started to jump, right? So the way to look at it is, where are we in the cycle? Now, if you are coming after a long stretch of weak earnings growth, then it's a good thing for you, because it means that you are probably at the start of the cycle. And so you have some runway for which your earnings growth will be reasonably good, right? And probably if, let's say, we are coming after 5-6 years of strong earnings growth, then you need to be a little more worried, because these cycles will again change, just like what happened historically. So now the first question is, where are we in the cycle? You can visually see that while for a lot of people, we were expecting the earnings growth cycle to change in FY17, something or the other came hitting. So in 17, by the end of 16, it was demonetization. Then there was GST. Then there was an NBFC crisis. And then the GDP growth slowed down. And by the time everything was picking, and then there was an auto slowdown. And then by the time things were slightly looking better, we had COVID. But you look at it that when something is about to turn and then you keep it suppressed for a long time, suddenly, despite the fact that you have something as bad as COVID happening, you saw that the earnings growth was like 23% CAGR for the last 2 years. And FY20 is not even the low base, like, because the COVID actually started, and FY21 was where you had the low base. So from FY20, if you look at it, it's 23%. And even if you look at a 3-year period from FY19 till current date, it's almost more than 20%. if you look at BSE 200 or any cuts and slice you do, you end up with earnings growth of around 20 to 25%. So anybody who saw the earnings growth alone will feel that COVID never happened. So that's the power of cycles, that when you're you are at the early part of cycle, irrespective, even if the environment is reasonably bad, the power of cycle will take care. So this is an important question that we keep asking: where are we in cycle? So again, we saw visually how we are still at the start of the cycle. The other way to look at this, so if you look at this, right, the other metric that we look at to ensure, to figure out where we are in the cycle is a ratio called where are we in the corporate profitability cycle. So a good measure is corporate profits as a percentage of GDP, right? 2003 it was bottomed at 2.7, then it went as high as 5. Now it again bottomed as 2.2, and now it's close to 4%, which is almost close to the historical averages. Again, if you do the same number with the entire corporate data, again, you find a similar kind of a jump happening. So overall, we are probably at the early stages of the cycle. The cycle started while you might not have this sharp jump in earnings growth, but it's a good expectation to have that the next 3 to 5 years will see decent amount of earnings growth because the cycle is just about started. Again, the same thing you can look at in ROEs, because ROEs were dropping and then finally it has started to jump back. Same thing for BSE 200. Again, the cycle is turning on. So you can see that after a long cycle, in March 2006, it went as high as 28%. Then for a long time, the earnings growth, it went down to 7.5. Now it's starting to jump back. So it's nowhere close to the 24-28% it reached in the previous cycle. The same thing you can see for Nifty as well. Right? And the third part we look at is a credit growth, because it's logically, the simple idea is that if I want to buy a house without a home loan, maybe it might take me another 5 years to save up or 10 years to save up. But if somebody gives me a loan, even with 20-30% of the entire amount, I can take a loan and then start it off. So what will happen is that a credit or a loan basically prepones my consumption, and it's generally good for growth. Now, for a long time, we were also seeing that if you look at FY 09 till now, right, the credit cycle was also weakening. So it almost came down as low as 6% vis-a-vis 37% growth that you saw on the peak of the last cycle. And now finally it has started to turn. It's 13 a few months back. Now it's almost crossed 15, 16. So this is also picking up. So overall, if you look at it, and again, if you look at it from a GDP point of view, before COVID itself, the GDP has started to slow down. So by the end of FY21, we were already at an end of a 4 or 5 year GDP slowdown cycle. So that again, at a low base, and the fact that you have already gone through 4 or 5 years of pain means that from a GDP point of view, also we are at the start of the cycle. So overall, if you really put it all together, right, you look at corporate profits to GDP, we can start with the earnings cycle. We are at the start. Here, corporate profits GDP again shows we are at the start. Again, ROE, we are at the start. Again, credit growth, we are at the start. GDP, we are probably at the start. So overall, from 1,000 feet view, it means the environment is extremely favorable for a good earnings growth over the next 3 to 5 years. Right? Now that we've got the 1,000 feet view, now we come close to the ground, and then we take the 100 feet view saying, what are all the various drivers? So broadly, we see two legs of driver. Now, obviously, because I told this is a very large presentation which has everything, I've just put it down into one single slide. So on the demand side, one of the biggest changes that's happening is on the manufacturing side, where PLI has become a huge hit, and overall it's expected that it'll at least add 1.5-2% to the GDP over the next 5 years. And you're seeing a lot of traction. Electronics has already been a huge success, and a lot of traction happening on auto, pharma, textile. So PLI is becoming the biggest success for manufacturing, and the government's intent is to take manufacturing from 15% to 20% of the GDP. They've told 25%, but 20% of the GDP is, and a lot of companies are also participating in this. And the other factor, so PLI was not there pre-COVID. Now PLI is there. The second thing was China plus one. There was no animosity towards China. That has suddenly come, and everybody is looking to diversify their base. And the third point is the government also gave a tax incentive in FY19 end, saying that all manufacturing firms, your tax will be at 15%, provided you start within the next 2 or 3 years. So which means that everybody is putting up plants left, right, center. so that because one, you have PLI advantage, and then you are seeing the demand environment due to China plus one and the tax incentive. So these are all the things which were not there pre-COVID, and the government is also focusing big time on moving a large part of defense procurement to local production. So this again, a lot of large firms are there. So manufacturing as a segment can become a big theme over the next 5 to 10 years. Then financials, if you look at it, fairly simple. All the problems are cleaned up. Raghuram Rajan started cleaning up in 2015. So almost for 5 6 years, the banks were cleaning up. And then COVID, they again became very, very conservative. They loaded their balance sheet. They started raising money because they were preparing for the worst case. So they were not lending. They were cleaning up their balance sheet. And if you look at the profits of SBI, Axis, and ICICI, you will see that after 5 6 years, suddenly they're jumping up drastically. Now, this is because for a long time you are not lending, you are cleaning up. You are only accounting for the loans which were going bad. Now you're also re-getting some. You're also getting back some of these loans. At the same time, you're seeing significant jump in profits. So overall, your credit growth is picking up. Your asset quality, the worst of it is already covered for. And there's a huge trend towards financialization of savings. So overall, we think financials as a pack can also do well. And this is almost 35-40% of any index or any fund that you take. The third leg would be from the capex, which is real estate is picking up because for almost 5-10 years, real estate prices didn't move up while our salaries went up. If you look at the affordability ratio, is best in the last 20 years. And you're also seeing strong signs of pickup across the country. So this is one. And then government is also significantly focusing on a lot of infra spend, which is evident through budget and through their other plans as well, the infrastructure pipeline plan and all that. And you're also seeing early signs of corporate, nothing big enough, but yeah, usually it happens only when you see GDP growth very strong, credit growth pick up, and then the confidence is very high. But usually what happens is when capacity utilization levels touch that 75 to 80, most of them start planning, and we are back to that 75 to 80% level. So, and we are almost seeing in pockets, we are seeing that early signs of corporate cap. So all these three will again become a big kicker. And tech, while temporarily it will get affected due to US recession and slowdowns, but there's a huge shift in terms of work from home. Technically, makes Indian talent global. So, which means tech guys are also getting paid insanely well. And you've already seen a lot of, while there is some concerns now, there's this moonlighting and all these issues, and that frenzy is no more there. But the point is that a lot of these tech folks have become global talent, and net their salaries have increased significantly. And the structural drivers are in place because everybody realized that there's no other choice but to make your business digital and go to cloud. So almost every company, what they would have probably done in 5-7 years, have tried to prepone it to 2-3 years. Now, maybe because of the current concerns, there might be few lags, but from the current IT commentary, it doesn't seem like there's any major delay. But if it continues for another 6 months to 6 months, there may be some delays. But this is temporarily. There are some concerns, but I think from a 5 year, 7 year, this again is a strong driver. And the fifth leg is the consumption, which is a traditional strong leg. And usually what happens is once your GDP per capita kind of moves beyond a certain number, your discretionary spend suddenly jumps, because earlier a large part of it goes through whatever was something that you can't compensate for, predominantly your food and housing. But beyond a point, your salary starts to increase, then significantly you will find that your discretionary spend start to jump. Now, this has earlier happened for China, this earlier happened for US, this earlier happened for Brazil. Now we are at that point from an Indian point of view. So over the next 10 years, you will find a lot of new consumption categories happening, and especially on the discretionary side. And with all the startups and all focusing on this, there's a huge consumption, which is technically always been one of the strongest themes in India. I think next 10 years we'll see this disproportionately growing. So overall, we think on the demand side, these are the core 5 drivers that we are seeing for the next 5-7 years. And now this demand is coming. Now, who will capture it? Now, the good thing about the companies capturing it is that you are seeing consolidation, right? You're seeing big companies are getting bigger and bigger. There was one slide from, which I didn't include it today, but that slide clearly shows that over the last 2-3 years, the incremental market share across category, you take any category, it went to the top guys of those industry. It might be top 3, top 5, but depending on the distribution of the industry, the top few players have taken out almost 70-80% of the incremental demand which came. So which means, especially this is on the back of GST, COVID, and all the small guys have been facing one brunt after the other. So the large guys, and also digitally, we have got connected as a country. GST is connected. The infrastructure has become so more and more as the country connects from a single place. You are able. So suddenly, if you look at it, the person who gives me grocery every day is Reliance through Milk Basket. Earlier, it was a local guy who was giving me. Now I've become too comfortable. Now mostly it's from Swiggy. So more and more things are becoming centralized. So larger companies are able to suddenly compete even at smaller ends because of digital spread, and also because of the fact that infrastructurally it's become easier, and the GST has made it a lot more easier. So that is clearly happening, and the balance sheets are cleaned out. The last 10 years, most of the companies have cleaned their bad debts, which is in line with what we told for financials. So you have high demand coming from these 5 segments. On top of it, the only few guys are going to capture it. And on top of it, you have a clean balance sheet. So which means if the demand increases also, you'll be able to put capex. So overall, it's a nice setup where cyclically the next 3-5 years look great. On top of it, your demand is coming from these 5 segments, and the companies are perfectly positioned because big is getting bigger and the balance sheets are clean. So if you take a step back and then look at it at a macro level, this is a beautiful setup for a strong earnings growth environment. So, and now the question is, are we seeing this actually translate? Because in the setup, like this is all fine, but where is the data? So you can see that the last 3 years, right? You can see that the PAT has grown almost 18-19%. If you knock off metals and oils, it's 19%. If you include metals and oils, it's 18%. And this is for BSE 200, which broadly covers the top largest 200 companies of India. And this is a good, now, and it's not concentrated only to Nifty 50. Same thing, you can look at it. This is on a quarter basis, but if you look at it on a yearly basis, FY22 to FY19, the overall PAT growth is close to 21%. So this, you look at this number, as I told you, it really looks as if COVID did not happen at all, because in spite of everything going wrong, because of the fact that the cycle was in our favor, we still ended up making 21%. So that whole theme has started to play out. And our sense is that while you won't make 20% plus, but there's a very decent growth prospect for the next 3 to 5 years. Anything between 15 to 20% should not come as a surprise. And the same trend you are seeing, right, in quarterly, how it's picked up. And in BSE 200 PAT growth, the broad expectation is 11% and 21% over the next 2 years. So roughly the expectation is somewhere close to 15%. And if there's any slowdown and all that, maybe it might come slightly down. But net, the core idea is that the earnings growth is in a very, very good shape. And for the next 3 to 5 years, you can expect decent earnings growth. Our expectation is roughly around the 15% number. So overall, from an earnings growth point of view, we are very, very comfortable. So valuations are okay. Earnings growth is very, very comfortable. And next, the third important point is the sentiment, because sometimes when valuations become expensive, I've seen the biggest mistake is that you only go by valuations and you go underweight. But if you don't combine it with sentiment, then you end up moving out of markets a long time back. I mean, in the sense like too early, and by the time the call comes out correctly, most of your clients have left you. And I've made this mistake a lot of times. And there's also an interesting paper which I recently read, which tried all the timing valuation indicators in US, and they found that none of the indicator was able to time a market correction precisely. One indicator would work 2 times, and the third time it won't work. So which is why we are very scared to use only valuation. And we have found that when you combine it with sentiments, you get a better nuanced view of how to take calls. So earnings growth, when it is positive, generally we are very, very reluctant to go underweight. And let's look at what the sentiment is telling us. See, generally the sentiment, how do we measure? The idea is very simple. It's just what happens. Sentiment is basically how much is the demand and supply. Demand comes from FIIs, demand comes from DIIs, like how much are they buying, and the supply comes from IPOs, right? If you look at it from the demand point of view, usually we get a little worried when FIIs are also significantly positive and DIIs are also extremely positive, which means everybody is positive, which means most likely your valuations are high. At some point in time, if one of these guys give up, there's no other guy to absorb it. And usually that's a very negative indicator. Right now it's neutral because DIIs are insanely positive while FIIs are negative. And here is something interesting that we did, that every time when the FII flows are negative on a 12-month basis, you've always made significant returns over the next 2 to 3 years. Now, why does this happen? Fairly simple. FIIs structurally have always been positive on India. And now it becomes even more a no-brainer because you look at all the other countries. India is in the top 5 GDPs. And then eventually it will become top 3 in the next 5 to 10 years. And then look at all the other countries. Japan is there. I mean, they can't invest there. I mean, like, it's not done anything in the last 20, 30 years. China is there. And all of us know China is like it is like it does well. And then suddenly, if you look at MSCI China for the last from 93, the USD returns are 1.2% CAGR. So China it does really well in 2-3 years. And then the government does something, and then it again does bad. So China is not something that's very structural about. And right now everybody is worried. And then there's a lot of problems between US and China. So if you really look at the options, right, Russia is gone, and then all the other countries are too small enough to absorb large amounts. So India it's almost impossible for a global investor to ignore India. So which means eventually they will be back. And which is what has happened historically. If you look at all the periods, right, 1, 2, 3, there are 6 instances where it happened historically. And in all those instances, you made like almost 15 to 20% over a 3-year time frame. In April, last time it happened, in the next 2 years, you made a 33% CAGR. This is the absolute return. So on an absolute basis, you make anywhere between 60 to 100% over the next 3 years. So which is why right now the 12-month flows are negative. So which means historically you've always made money when the FIIs get back, irrespective of where the valuations are. So when this sentiment indicator, that is the 12-month FII, becomes negative, I become super positive on equities. And generally it's a very, because once the flows come in, right, it's too difficult, because once the flows come in, the markets will be forced to go up, because who will absorb the FIIs have almost taken off 2.5 lakh crores. Now, when they get it back in, who will absorb this? Because DIIs are also buying. So somebody will have to sell. The promoters are either way not selling. So suddenly when 2.5 lakh crores comes back, and you would have seen that initially 32 billion went off. And then I think 5 billion came, and then we had already recovered. So 32 billion went off. We were only down 16%. And then like 3-4 billion came, and then we were already up. Then it went to 5-6-7 billion, and then now they've again started to take out in the last 1-2 months. So overall, once this trend of FIIs coming back comes, we'll see there's high likelihood that we might see some sudden sharp upside rally. And on top of it, why we are a little more comfortable is that even if there's a further downside, there's a huge amount of inflows coming up from DIIs, because if you look at the SIPs, which is coming very structural, it's almost 1.5 lakh crores which comes every year, because at 12,500 crores every month. And if you look at 4 or 5 years back, it was sub 2,000, 3,000, sub 2,000 crores. So this was never a stable inflow a few years back. Now this is a new indicator that all of us must be aware of, because this was not there 5 years back. Now this new large gorilla is suddenly come into it. So which means our market, this is a significant stability factor for our markets, which was not there 5 years back. So the setup is, and then obviously balance advantage funds and a lot of these active funds have some cash allocations. So if you put all this together, we have 3 lakh crore buffer here. And on top of it, we have another 2.5 lakh crores, which can come from FIIs any point in time. So net, if you look at it, if this kind of amount is coming from, where do you buy these? If you have to buy this, somebody has to sell, right? So which is why from a sentiment point of view, I'm very positive. So overall, it's a neutral sentiment where we would have become, I would be very positive, but because DIIs are extremely positive on one end and FIIs are negative, we are still in neutral. If you look at all the other indicators, we look at IPO flows have tempered down. We look at another interesting indicator, which is how much are the insiders buying, which is the own promoters buying. So that if you look at it, after a long time, it's turned. And you historically look at it, whenever promoter buying increases, it is a very good indicator. They drastically increase, especially in that quarter where the markets were down 15, 16, 17%. So which means when the markets go down by another 10%, that's the level where promoters are buying in left, right, center. So right now itself, market looks attractive. So any fall from here will make it even more attractive. Then if you look at leverage, there's hardly any leverage. If you look at the momentum indicators, they're also not showing any signs of bubble kind of thing. If you look at last 3 year, 5 year return, it's all 10 to 10, 11, 12% kind of numbers. A few indices might be sub 15%. But if you look at FI not 8, it was almost 45% CAGR. So you're not seeing any signs of bubble in terms of past returns or the IPO moment, or your new retail investors are also going down. So look at all the usual new bubble indicators. They are not at all worrying at all. Most of them have sobered down, and all this Bitcoin and all the noise is more or less done with. And the market is still stable thanks to the DII flows, which is the structurally a new gorilla which has been added to the equation. So putting all this together, it gives us a very simple view that valuation is neutral, sentiment is neutral, and the FII flow negative, meaning that the entire amount will come back at some point in time, is a key indicator that you should definitely not be underweight equities at that point in time, because at what point in time this will turn, we do not know. Earnings is again a reasonably good environment. So overall, putting this together, our view is fairly simple, that we continue to neither be underweight nor overweight on equities. And incremental allocations, what we are doing is 60% we are doing it through STP, and 40% we are immediately deploying. So if a client gives us 100, which is meant for the equity bucket, then we put 40 rupees immediately, and the 60 rupees we do it through a 3-month STP. So that's how we are currently deploying it. And if the market falls below 50,000, which is a 20% fall, we become very, very aggressive. We start moving money from debt to equity. Overall, the risks are like whatever we know, that US is obviously going through. The biggest risk is what the Fed is currently doing. They're going insanely high on increasing interest rates. But the good part is that commodity prices have started falling down. US real estate prices are showing signs of weakness. So if you look at it after 6 months, you will find that real estate is going down in US. And then so net US will go mostly through a slowdown. And once you go through a slowdown, eventually the markets or at least the inflation numbers will start to come down. So the moment it becomes a slowdown, again, the way the markets now are, that any positive news, they are getting worried, because then the Fed is more aggressive and pushing it up. Moment you get negative news, then the markets are like, okay, so finally Fed will stop. And now the point is, Fed also has the leeway, right? Now it's at, if they increase their rates to 4.5%, now they again, it means that you can also reduce it to another 2-3%, you can reduce it. So I think it'll be a very difficult market, especially the global context, so which will again have a repercussion on our markets, because the FIA flows will really depend on them. So my sense is it's a good time where you gradually keep building and not stop your SIPs and continue. But the surprise will come when the FIA flows come in, or there is some, if the inflation numbers in US drop, and the FIA and the Fed, before even increasing or reducing their interest rates, the Fed gives any positive commentary, it can the whole sentiment can change in a few weeks. So my sense is it'll be very sharp, but it'll be very sudden, and nobody has a clue on when all this will happen. But if you really look at, will it coincide with the economic growth and all that? It won't. Will it coincide with good news? It won't. Just like what happened in COVID, historically markets will jump right in the middle of bad news, and it will be super fast. And most likely the growth, it will be like far ahead of the actual growth going up, and a lot of predictions will go insanely wrong. So our overall view is that we are comfortable on the Indian equity side, while all the risks we are aware of. But overall, putting all these three things together, we find no reason why we have to go overweight or we have to go underweight, but we'll continue with our existing allocation. On the US equity side, we're also finding that the valuations are becoming reasonably attractive. Look at it, US S&P 500 generally bottoms at 13 to 15 times PE, forward PE. Now it's almost close to 15 times PE. So, and if you look at the sentiment indicator, it's at the bottommost every time you have made money after that. So overall, US looks interesting. We are gradually in our aggressive bucket. we're gradually building our exposure to NASDAQ as a contra call. But again, I leave it to that's like a very aggressive that you're it's a tactical bet that we are trying to take, but we are not going all in. We have taken a structured piecemeal approach where we'll put, let's say, out of 100 rupees, we'll put 20 rupees today. And at the next level that we have marked, we will put 30 rupees. Then the third level, we'll put another 30. And the fourth level, we'll put another 20 and finish off the 100. Now, will we get all the four levels? We don't know. But we want to definitely participate in NASDAQ at this juncture. So it'll take us time to build depending on how the market falls. But if it recovers, yeah, we will only get some partial participation. So that's the broad view that we have at this moment.
Thank you, Arun. And thank you all for your valuable time. Use of this session. We'll be sharing a link in the chat box for your swift feedback and response. We'll also be sending you a link via email in case you want to share feedback later. 2 minutes of your time to respond to the same. Until next time, this is Sharon signing off. Have a good day.
Thank you, everyone. Thank you.